Hey everyone, in this video I'm going to highlight my top 17 stocks to buy for the second half of 2023. Now I started the year with a big list of stocks to buy. I've added, I've subtracted, we've made gains, we've made some losses. Overall the portfolio is doing well, which I will show you the update, and I will share with you all of the stocks I've included. Along with, there's several changes to this update from the previous update. I've added some stocks here that I think it's time to sell. They've grown, they've increased in value significantly. I think it's time to take some profits. I'll share with you which ones those are as well. So let's get right into it. Starting with my first group of stocks that I think are still on the top of my list for stocks to buy, and that includes Deere, Caterpillar, DocuSign, Fiverr, Etsy, eBay, Alphabet, and 3M. Now, what you'll notice with all of these, what I've also included here is a chart of their forward price to earnings ratios, and all of these stocks are trading relatively inexpensively at a forward price to earnings ratio of less than 20. Now, these stocks, some of them have already performed quite well for the year, but I still think they've got room to go. I still think they are strong buys for the second half of 2023. So moving on, the second group of stocks that I think are strong buys for the second half of 2023 are the Home Depot, Target, StoneCo, PayPal, Starbucks, the Walt Disney Company, Airbnb, Visa, and MasterCard. So there are a few stocks in this group that are slightly more expensive. Notably, the most expensive stock I have in my portfolio recommendation is Airbnb. Airbnb stock is already up significantly for the year. So if you bought it at the beginning of the year when I recommended it, you are up considerably. But I still think the stock is one of my top stocks to buy. Folks are unleashing pent-up demand for travel. There is strong pent-up demand for away-from-home experiences, and I think that's a theme that you can see in the portfolio with companies like Airbnb, Disney, Starbucks, and others that benefit when people go out of their homes and spend more money away from their home. Moving on, the changes I'm making in the portfolio in this update are four of them: Netflix, Microsoft, Adobe, and Salesforce. I'm recommending now to take profits. Let's sell these stocks. We've already made very nice gains for the year on these stocks. Salesforce is up over 70% for the year. Adobe is up over 50%, as well as Netflix, and Microsoft is up 41%. I've had these stocks as recommendations since early January, so I think now is a good time to take profits, sell these stocks if you have them. If not, then you can wait for a better entry point to get into these stocks. Now, all I'm doing with these stocks is removing them from my list of top stocks to buy. Now, I still have these stocks rated as a buy, but they're just not on the top of my list anymore. So they've grown so much, they've increased in value so much that I'm taking them off. I'm downgrading them from my list of top stocks to buy and just rating them as a buy. So to wrap things up, so far this year, I've these are some of the stocks that I've taken off my list of stocks to buy. Meta Platforms I took off about a month and a half ago when the stock was up about 100%. I said it was time to take profits. The stock has increased since then. That's okay. I'll take my 100% profit. I'm not regretting that it had an extra 55% profit since I asked to take it off my list. Palo Alto Networks also increased in value nicely for the year. I took that off. Mercado Libre also took that off after an increase in value. Domino's I took off my list, not because it increased in value, but because there were some changes I didn't like. So I took Domino's off my list earlier in the year. Same thing with Nike. I took Nike off my list because I noticed some things I didn't like about the company. And then finally, Chegg, which I took off my list about 1 month into the year, around late January. I took it off my list. You notice here the stock has crashed since then. I predicted that Chegg was going to be the one company that would be significantly hurt by the rise of ChatGPT and artificial intelligence. So if you were following, I told everyone to avoid this stock, to sell Chegg, and I still say that. I don't think it's a bargain, down 63%. I think investors should still avoid Chegg stock. So there you have it. Those are now my updated list of my top 17 stocks to buy for the second half of 2023. If you want deeper analysis on any of the stocks that I recommended, I have several videos on every one of the companies that I've mentioned in this video. So please feel free to dig through my channel, find those videos, and get a deeper analysis on each one. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.